Welcome everybody to Centura's Philanthropic Planning Series. Thank you so much for joining us. I'm Dana Levin and I'm Centura's Manager of Philanthropic Strategies. I oversee our Centura Foundation, provide education and guidance around our philanthropic client strategies, and build our nonprofit partnerships. For the nonprofit professionals in the room who I have previously met, it's nice to see you all again. And for the lay leadership and donors who I have not yet met, I look forward to meeting you, getting to know you, and hear about what inspires you to give so generously. Before I joined the team at Centura last year, I was a nonprofit fundraiser for the past 15 years. I understood financial transactions that had charitable benefits, but I never had someone in financial services reach out to me and offer to engage with me and my organization to support our fundraising efforts. I want to be that bridge between nonprofits and the financial services industry to build partnerships and raise money for organizations in the community while also helping donors to strategically leverage their assets to support their short and long-term financial goals. So now let's dive into today's presentation. But before we get too far, please make sure that your camera is on if you are able and ensure that you are on mute. I also want to remind you that today's presentation is being recorded. Also, in yesterday's confirmation email, there were instructions to download the handout that you'll want to have handy as we walk through today's presentation. Please make sure that you have it printed or use the fillable PDF on a second screen. This is not something that anyone will see except for you. Finally, if you have questions for Kyle along the way, we would certainly love to hear them. Please type your messages into the chat or chat them to me privately, and I'll field them to him during our Q&A. Next slide, please, Sean. Thank you. Today, we're going to be focused on a Charitable Lead Annuity Trust, or a CLAT, which is most often one transaction as part of a larger portfolio strategy. The CLAT structure has income tax benefits, can be an excellent solution for capital gains and estate taxes, creates an annual plan for philanthropic giving, as well as being a meaningful way to safeguard assets against the upcoming potential legislative changes. As we walk through today's presentation, we will review a current client case and discuss some ways this family can maximize their estate for both family and friends, as well as charity. We will also look at a variety of planning opportunities to consider, how they should be structured, how they might be funded, and how to time them so that the organization's needs are aligned with the donor's payment schedule. So now, raise your hand if you know who this famous family is. Yep. So most of you know it's Jacqueline Kennedy Onassis and her family. What you might not know is that she popularized CLATs. CLATs have a long and rich history in estate planning. They've become even more prevalent in the last 5 to 7 years because they work well from a transaction point of view when interest rates are low, like they are now. As a result, many families are using the current environment to plan their philanthropy for the next 20 years. And now I'd like to introduce you to today's speaker, my colleague, Kyle Malstrom. And since the early 2000s, Kyle has been placing clients first and serving as a steward and fiduciary to high net worth individuals and families. Kyle is the managing director at Centura Wealth Advisory and empowers his clients through educating and implementing proactive wealth planning solutions. He has over 28 years of active experience in financial markets, including 6 years as a NASDAQ market trader. And with that, I'd like to turn it over to Kyle.
Thanks everybody for joining today. I'd like to give a special thanks out to Dana for putting this presentation together and getting everyone here. If you know anything about Dana, she lives and breathes nonprofits. It is her North Star. She is ridiculously passionate and tenacious about making an impact for everybody involved in the nonprofit community. If you don't know Dana, I highly recommend you get to know Dana because she'll bend over backwards to do anything she can for you. And she's super resourceful. I'm super proud to call her my colleague, and I can't say enough about her. So thanks a lot, Dana.
Thank you, Kyle.
So my name's Kyle. My primary role here at the firm is to help clients make great financial decisions. In that process, I bring actionable and effective solutions to the table. And today's topic is both actionable, very effective, and very timely. Our firm has helped design and set up over 100 of these trusts, which has resulted in over $60 million in charitable donations, which will be realized over the next 20 years. And today's topic I want to relay can do 5 different things. So you might want to write these down. We're going to go through them through the presentation. But before I tell you the first benefit, I want to put on my hat as an advocate for the 501c3 organizations that brought you here today, because as you know, they're in a constant state of raising money. They raise money in lots of ways, but the most important thing I think you need to remember is that they spend a lot of time and effort to raise money for the causes that are near and dear to you. And with any organization, the more predictable the annual raises, the better job they can do with budgeting. So an ideal situation for a 501c3 is to have a steady, reliable baseline cash flow from their donors, which brings me to the first benefit of this strategy. And that is this strategy can create an income stream for the charity for a selected period of time. That period of time can be 5, 10, 15, 20, 25 years. And it allows that organization to budget a little bit better, to spend more time on the causes that you support. So as a donor, you also get to see the benefit of that money getting put to work in a productive, meaningful way here in your community. The second benefit this strategy is going to offer up is it could provide a big lump sum of cash at the end of the term, which think about it like planned giving. And so now not only are you giving annually, but you're also going to give, or you're going to earmark a chunk of change at the end of the day that can be put to work in a meaningful way as well. The best part about the future contribution that you're going to make is that it's really a redirection of money that you ordinarily would have paid to the IRS. And so our clients, when we talk to our clients about, hey, where do you want, at the end of the day, what do you want to do with the cash and what do you want to do today? What do you want to do with the assets in the estate? None of them say they have any real interest in leaving any money to the IRS. So this strategy takes into account that, hey, part of your goal may be to eliminate the IRS from your distribution strategy. And by redirecting that money to charity, we can make everything a lot more tax efficient. So the fourth benefit is it will create an income tax deduction today for you. And the way the deduction works is that the deduction is based on the future contributions that you set up and fund today. So in other words, you're going to get a deduction today for all of the gifts that you're going to make over a 10 or 15 or 20-year period. And we're going to spend some more time here in the presentation, but this is really where the power of the strategy comes into play, is this tax deduction today and the time value of money. And it's just a financial equation. And then the fifth benefit is that you can create more wealth for yourself or your family or for your charitable organization. And it's really a wealth building strategy. So I covered a lot there, but a quick recap in case you missed the high level bullet points is really reliable income to the charity, an end of term lump sum to the charity. You get to redirect assets from the IRS to charity. You get an income tax deduction today, and you can create more wealth for your beneficiaries, whether that's you, your family, or your charitable organization. So let's get started. So to set the stage, I think it's important to review the tax environment. And if you look at this slide, you'll see the prevailing trend is the tax rates for ordinary income, capital gains, and qualified dividends has gone down over the last 60 years. However, in 2012, you'll see a slight uptick with the Obama administration. And then unfortunately, the slide ends at 2018, but then there's a slight downtick when Trump took over. And now we have President Biden in charge. And he's openly ran on a platform of raising rates from a capital gains standpoint, from an ordinary income tax standpoint. He has put income tax risk on the plate for many Americans and many taxpayers. So that's one thing that we want to be cognitive in tax planning is, okay, what are future tax rates going to be? And they haven't decided, they haven't set on any laws yet. Where it ends up, I don't know. But the overarching communication out of Washington is tax rates are going to go higher. The second tax that the government likes to assess, particularly on wealthy families, is the estate or the transfer tax. So what is the estate tax? The estate tax in its simplest form is a formula where the government says, hey, if you have more money than X, we're going to take 40% of it. And today, X, that number is $11.7 million. So as an individual, you can leave $11.7 million to your beneficiaries without the government taking any money. As a couple, that's $23.4 million. So the chart on the left, you can see that state exemption has been going up pretty steadily over the last 30 years. And then it drops off, and that is actually represent the sunsetting of the Tax Cuts and Jobs Act, which made the exemption 11.7. When Congress passed it, they said, okay, hey, we'll take it up there, but we're going to sunset back to the 2017 levels with cost of living. So it's going to sunset in 2026 back to about $6 million. So even if the Biden administration doesn't do anything with the estate tax law, there is the risk that the exemption amount is going to fall back to $6 million. And the Biden administration has openly, they ran on a platform where they're going to reduce it even lower than that. It's kind of a political volleyball what they do with that number. I don't know where they're going to land, but they're talking about it. Next. So I believe an easy way to relate the power of this strategy to you is through an example of a client. And this client, we're going to call him Mr. and Mrs. Kendall. They have an estate worth $15 million. The current estate exemption is $23 million, so they don't have an estate tax today. They do have a concentrated stock position of $10 million, of which $8 million of it is long-term capital gains, unrealized long-term capital gains. So they have an issue if they sell out of this stock. It's a concentrated position. They're a little concerned about it being a concentrated position because there's a lot of risk in having that. And their goals pretty straightforward. They want to make sure they're taken care of, and they believe they are. They have nice pensions, they have nice income. And then when you talk to them about, hey, where do you want the money to go at the end of the day? And you say friends, family, church and charity, synagogue, charitable organization, or IRS, they have a strong aversion to the IRS getting the money. They're already philanthropically involved. They give money today. They would rather the money stay locally. That is just where their passion's at. That's who they are. And so, they talk to us about some key issues, right? Well, my estate's got exposure in 2026. I plan to live past 2026. So I'm going to be affected by this. And we say, yeah, you are going to be affected by this. And then they say, well, Biden's running on this $3.5 million exemption. That would really impact us. And we said, yeah, it is going to impact you. I don't know if it's going to be 3.5. I don't know if it's going to be 5.5. I don't know what the number's going to be. Could just sunset to 6. Either way, you're going to get impacted. And they're asking us what strategies based on our current philanthropic gifting that we already do and our overall estate plan and everything we've relayed to you, what are strategies we should consider? And this is one of the strategies that they considered and implemented. So let's look at a quick analysis of the estate tax piece. On the left is the current law, and on the right is the proposed legislation. On the left, the current law under the Tax Cuts and Jobs Act that's going to set in 2026. The current exemption is $23 million. You can see they have $15 million. They don't have an estate tax today, but they recognize 2026. They will. The exemption goes to $12 million. That will expose $3 million to tax. If it gets taxed at 40%, there's $1.2 million that's going to go to the IRS, and that, it's 8% of the estate. They don't like that. They don't want that. Biden openly ran on a $3.5 million exemption since he's been the president. There's been some discussion of whether it's going to be 3.5, 5.5. Then they kind of took it off the table. I kind of think they took it off the table so they could catch people not doing planning and then stick it back in at the end of the year. But I don't know. That's just my personal speculation. But if they do reduce it to $3.5 million, on the far right, that proposed legislation, they have an estate without any growth in the estate. At the second passing, if their estate's $15 million, $7 million of it's protected. They have $8 million that could be potentially exposed to the estate tax, which is 3.6. It's 3x what they already are. So they weren't happy with 1.2 million. They're definitely not happy at 3.6. You know, where's that number fall? I don't know, but they would like to mitigate that issue. That was one of their primary goals, right? Hey, help us with this. So we said we can do that. On the income tax piece, the current law says, hey, if the asset is held jointly as community property, at the first passing, you'll get a step up in basis on all of the assets. And so they have this large concentrated stock position, it's $10 million. There's an $8 million gain, and at the first passing, it would get a step up in basis to the $10 million, and then they could diversify out of that position and take that portfolio concentration risk off the table, and then they could sell and they don't pay any tax, because when it steps up, it's now as if you bought it for $10 million and they could sell at $10 million and they don't pay any tax. The current tax rate for them, they have nice pensions and Social Security, and they have a steady stream of income. Their income's over 500,000. I think it's 550. You know, if they sell it today, they're going to pay 20% long-term capital gains tax rates plus net investment income tax rates 3.8 plus California. It's pretty expensive to be selling. So they don't, you know, they're trying to figure out how to get out of it. Under proposed legislation, and there's a lot of stuff being bantered back and forth, one thing that they've proposed is the elimination of the step up in basis. That would be massive to this family. They've also proposed moving the long-term capital gains rates all the way up to 39.6. Maybe they move it to 30. I don't know where it's going to land. But in a worst case scenario, if they eliminated the step up in basis and it goes to 39.6, and let's just say for sake of argument, they decide they don't want to sell and they leave it all, you know, they leave the vast majority of the estate to the family, and then the kids go sell at that tax rate. You know, there's $3 million of taxes here that they want to mitigate. So they see the risks and they're like, what are some solutions? So looking at going back to the estate tax piece, you know, there's lots of different strategies out there. You guys may have heard quite a few of them, from CLATs and intentionally defective grantor trusts and ILETs and CRATs. And there's tons of these acronyms out there. The one we're going to focus on today is a Charitable Lead Annuity Trust, because it is actually a very good wealth transfer asset. It is a way to get assets out of the estate for them to grow outside of the reach of the IRS's estate tax formula. So we're going to talk about that. So again, we're trying to save the 1.2 to 3.6 million dollar liability, pending liability. And then on the income tax piece, there's lots of strategies as well, from gifting to there's Ing trusts, and there's private placement life insurance, and there's tax harvesting, and there's exchange place that they could do. We got lots of tools. We have lots of strategies we could embark on. But what matched up for this family was, because they already give money annually, and because they want to leave money to charity at the end of the day, the Charitable Lead Annuity Trust, in combination with their estate tax planning, it really dovetailed nicely. And so that was one of the strategies we pursued, and that's the one I'm going to share with you. So what is a Charitable Lead Annuity Trust? A Charitable Lead Annuity Trust can be set up by an individual or a family or a corporation, and the creator, the family, in this case the Kimballs, they are the grantors, the creators of the trust. And what they do is they sit down with myself and the attorney and the CPA, and we go through the design of how they want it to work, and we're going to talk about that. And once we've finalized the design, then they draft up the trust. It is an irrevocable trust, and they contribute assets into this trust. And they can contribute stock, cash, real estate, CDs, you name it. They can name just about anything. And you can put it into this trust, and then they have control of this trust. They are the trustees of the trust. So they're the creators and the controllers. So they can buy and sell inside of the trust. They can invest the assets. And then there are two beneficiaries. There's a primary, the lead beneficiary, and then there is a remainder beneficiary, which is what happens at the end of the term of the trust, where if there's any assets in the trust, where does it go? For those of you who are familiar with a charitable remainder trust, this is the flip of that. This is the opposite of that. A remainder trust, all of the income goes to the grantor, and then whatever's left over goes to the charity. In a lead trust, the income goes to the charity, and the remainder goes to the family. But they could name a foundation as well, or they could name your charitable organization. Next. So the design process, a very critical aspect of doing a charitable lead annuity trust. And we do painstaking work to get it dialed in just right. There's lots of levers, lots of knobs, lots of dials that you can turn to optimize this thing. But try to be in a very concise, summary way to think about it. What we do is we do what we call a 6-year adjusted gross income projection. And what that means is we want to add up, you'll see on the bottom left, the adjusted gross income, kind of like your tax return, right? I mean, that's where the term comes from, and it is specific to the calculation here. So we want to add up your wages, we want to add up your dividends, your capital gains, your pensions, your Social Security, your K-1s, all the income that's going to get taxed. We want to back out retirement contributions, and we get to the same line item that's on your tax returns called adjusted gross income. And what we do is we do it just for 1 year. We do it for 2021. And we say, okay, we add up all these items and we do all the math. And for this family, it was $550,000. And once we get 2021 dialed in, then we ask questions about 2022, 2023, 2024. We go out another 5 years, and we left out all of those categories up top just to make it easy. But we add it all up, and we get a baseline of what we believe and what the client believes is the most reasonable expectation of what their income is going to look like for the next 6 years. And why 6 years? Well, with a charitable deduction, if you don't use the deduction all in the first year, you get to carry it forward into future years up to 6 years. So what we don't want to do in the design of a CLAT is have a deduction that's not used. We don't want a deduction that's going to last more than 6 years, because that would be a waste of the deduction. The power in the transaction is part of the deduction. So we want to know, what is the total income? We want to know specifically what's the income for each year. And then the deduction is based on what you put into the trust. The clients put in cash. So the cash says, hey, you get a 30% deduction against your adjusted gross income, which is what we calculated. So you'll see in 2021, we have that 30% number. So there's a $165,000 deduction that they could use in 2021. So this client did $1 million CLAT. They only get to use $165,000 in 2021. And then they get to use $165,000 in 2022. And it was, in this example, it's level. It's much more dynamic in a real life situation. This is a real life situation, but we made it easy for everybody. But it's very dynamic, and you want to get pretty specific here so you can get it dialed in just right. And then we look at the marginal tax rate, and we say, okay, hey, where does this deduction fall in the tax rates, and how do we get the most bang for our buck with this deduction? And for these clients, they're going to get $80,000 a year. It's almost $500,000 in savings over the next 6 years. It's real money. It's real meaningful money to these clients. And so we're really good at this process. This is what it takes to get it designed just right. And Dana, I think on the worksheet, isn't there a piece here?
Yep. Thanks, Kyle. So hopefully you all have your handout sample here and your phone, because you're probably going to need your calculator also. So hopefully you have that and a pen handy and are ready to walk through our handout for your own portfolio. So we're going to take a minute to go through and do this exercise together. So as Kyle outlined, one of the first steps in recommending how to size a CLAT and how to determine maximizing the charitable deduction is to estimate your adjusted gross income. So take a moment to fill out that number as accurately as you can right now. Now, step 2 is to estimate out your AGI, your adjusted gross income, for the next 5 years. So for years 2022 through 2026. Take a second to fill in that data now. Cash charitable deductions can be consumed, as Kyle mentioned, at 30% of your adjusted gross income over 6 years. As such, step 3 is to calculate 30% of your AGI for each year through 2026. This is where your calculator may come in handy.
Or Excel.
If you're doing the fillable PDF, that would work too. It'll automatically do it for you. So while you're finishing up with that piece, next you'll also see on your worksheet, we've listed the tax brackets that the majority of folks fall into. Using that table, you'll want to estimate your marginal tax bracket for each year 2021 through 2026. Now, finally, your last step will be to calculate the totals on the far right in the gray column and estimate your potential tax savings if you were to consider adding a CLAT to your estate plans. So hopefully you're just finishing up on those calculations, but hopefully you will see, for those who are philanthropically minded and motivated, which I know all of you are, this transaction should be a no-brainer. Now back to you, Kyle.
Thanks, Dana. I would add, obviously dividends, capital gains, taxed at a little different rate, so it's a little more complicated than that. And that's what we work with our clients on, is to optimize it. But you get a general sense of how powerful the strategy can be. So, Sean? So from a donor's perspective, from the grantor's perspective, let's just walk through some of the mechanics and some of the things that need to take place to make it all happen, right? And so you decide, hey, this is something I want to do. What we do is we design it in that similar fashion there. We do the 6-year adjusted gross income projection. We look at all the different tax characteristics of the flavors of the income, and we figure out the best design from how much money you want to give to the charity, who do you want to be the final beneficiary, just lots of nuances in there. And then once you kind of establish what you want, who the beneficiary is going to be, et cetera, we then draft up the trust, and then you need to fund the trust. And in this case, the Kimball's funded it with $1 million, and it ended up going to save them close to $500,000 over the next 6 years. From an estate planning standpoint, the clients didn't want the residual money to come back to them. They wanted the money to go to their kids. And this is where the estate piece comes into, the estate tax planning piece comes into play. And so in order for that money to be frozen outside of the estate and outside of the reach of the IRS's formula for figuring out how much they owe in estate taxes, they need to file a 709 gift tax return. And they send that into the IRS, and the IRS has a calculation that we use in this transaction to figure out what the remainder interest is going to be. And in this case, based on the IRS's formula, there's $1,000 remainder interest. I'm going to show you it's going to be dramatically different than that. But so for the IRS's, from the IRS's standpoint, they made a gift of $1,000. It's done. It's outside the estate. Okay. Now the CLAT, as the trustee, you get to invest in stocks, bonds, real estate. We're going to talk about what ideal assets are in there, but the assets that are inside of the trust then grow over the period of the term of the trust, and it stays out there. You can't borrow from it or anything like that. And then the CLAT on an annual basis makes an annual donation to the 501c3. Our firm helps with the management of the assets. Go back one there, Sean. Helps with the management of the assets, and it also helps with the deductions. I mean, if we manage assets for our clients, we'll help with the annual payment to make sure it's on time. Next slide. And then the CLAT on an annual basis does need to file a tax return, and we help our clients with that as well. We provide the CPA with the 1099s or K1s and end of year statements and things like that. We make it pretty easy. And the tax return has to get filed with the IRS. Now, with this transaction in a grantor CLAT, the tax implications of the trust flow back to the grantor. So we're going to talk about why you need to pick pretty specific assets to go into it. They're just more tax efficient. And then at the end of the term, in this case, the Kimballs chose a 15-year term. The remainder interest, whatever's left over in the trust after making 15 years of charitable contributions and a kind of a lump sum payout at the end, whatever's left over goes to the beneficiaries, which they named as their kids. And their growth rate assumption on their assets was 10%, and the IRS thinks it's going to be 1.2%. And so if it all goes to fruition as planned, there's probably going to be $1.5 million outside of the estate that's going to go to their family free of transfer taxes. So very, very powerful. So let's look at a CLAT payout example. This is the way they designed it. There are lots of ways you could design this. This is just one way to do it. So they chose to put in $1 million, and they chose a 15-year payout, $5,000 a year, which kind of matched about half of what they normally give. So that gives them some flexibility on the other $5 to tighten the belt maybe in a year, or redirect it to somebody that piqued their interest this year for a specific cause, something like that. And then in 2036, there's a lump sum payment of $1,051,000. So overall, they're going to give $1.1 million to charity. And again, this tackles a very predictable income stream to the 501c3, which is helpful for you guys on your annual budgeting. And then at the end of term, there's this big payout that they feel really good about. That's a much more meaningful plan giving type of gift. You can design this $10,000 a year. You could make it even payments all the way through. You could start at $5,000 and increase it by 10% a year. There's lots of different ways to design this. That's what we're here for, is to help you guys with that. But this is their example. At the end of the day, what are the results? And on the left is the current state if they don't do anything. And if they don't do a CLAT, if they don't put $1 million in this CLAT and get the tax deduction, there's really 4 places for the money to go. Is the total taxes, the remainder interest, what goes to the family, what goes to charitable organization, and what goes to legal and tax compliance. And you see the big red bar over there. There's $1.1 million that's going to get eaten up in taxes. So if they don't do it, as you remember from the 6-year adjusted gross income, there's almost $500,000 in tax savings that if they don't do the strategy goes to tax. And then because the Tax Cuts and Jobs Act sunsets, 40% of the growth of the assets up here that they didn't get out of the estate are going to go to tax. So there's $1.1 million in tax that'll get eaten up. And there's about $958,000 that should go to the family. By doing the CLAT You're directing that red box. You're saying, thank you, government, for the tax deduction. I have money in this trust now. One could conceptually imagine that if you put $1 million in and you got a $500,000 in tax refunds, that the government funded half of the trust. Now you're going to take the government's money and use it against their own calculations and grow it faster than they believe is going to actually happen. And at the end of the day, you've redirected that red box to charitable organizations to $1.1 million. And you got that asset out of the estate, which then is free of the estate tax, and you ended up transferring more money to your family to $1.5 million. That's a win. We like that. Our clients like that. So why are we talking about it? I said it early on in the presentation, it's timely. Why is it timely? It's timely because of the 75/20 rate. You can go to the irs.gov website, you type in 75/20, you'll see these rates. It's published every single month. And the 75/20 rate is a rate that the IRS publishes specifically for charitable trust calculations. And what it means is this is the growth rate they expect you to have inside of the trust for the life of the trust. And on the right hand, you can see that the graph, it's been going down for 30 years. And the last decade, we've had multiple opportunities where this rate's got pretty low. This year, it started at 0.6. Now in June, it's 1.2. Ridiculously low number, still super, super powerful. It's probably very useful all the way up to about 2.5. But we wanted to get this presentation out because this rate's starting to climb a little bit. And so if you're going to take advantage of the opportunity, it's most economically beneficial to do it when the rate is as low as it can be. So you actually get to use the lowest of the previous 3 months. So technically, if you did one in June, you could use the 1% rate. But that rate says, hey, remember in the example, there's that $1,050,000 out in the future. If you take that 1.2% and for the financial geeks out there, if you discount it back, that's how you get to that $1 million deduction. So the lower the number, what I want you to remember is the lower the number, the better it is, economically speaking, for all parties involved, and you're more likely to pursue the strategy. So as the rate goes up, it's still going to be really good probably for the rest of the year, but it's prime time right now. So preferred investments. So the donor puts the money in, the donor is the trustee, now you have to invest the assets. And I alluded to it a few slides ago. Real estate's a very good asset in there, primarily because of the depreciation. The depreciation shields all the income, makes it a little bit tax friendly for the donor. Long-term buy and hold growth stocks. You really don't want dividend paying stocks in there. You don't really want the dividends sending tax bills back to you. Private equity, and so we help our clients with determining what are the best assets, and we look through all their assets. We can figure out what we want to put in there, what we want to invest in. But the break even here, the break even means at what rate of return do I need to make in this trust where I'm agnostic to the transaction from a out-of-pocket experience. And out-of-pocket could be out-of-pocket to the IRS, or out-of-pocket could be to the charity. All of our clients would rather give it to the charity than the IRS, but just how does my family benefit in this? And the break even in this scenario was 3.84%. So call it 4%. So at 4%, as long as they make 4% in this transaction, they are neutral and they end up in the same place, but the charity wins big and the IRS loses big. So it's a win, it's just economically speaking, neutral for the family. But if you get 7%, you're $600,000 better off. If you get 10%, you're $1.4 million better off. Now, our clients were right in the middle of that, right? They were at the $1.2 million number, I believe. But if you put private equity in there and you're a sophisticated investor and you know how to get alternatives that produce exceptional alpha and good returns, the numbers get quite compelling, and you can see for yourself. I don't want to over exaggerate it, but it gets pretty awesome. It's a home run. I mean, it's a win-win all the way around 7%, I think is totally doable. 10% is doable, 15, 12, you gotta have the right investments. But there's clients that have it. We offer assets, you know, so you can see the numbers are quite compelling. But you gotta get the right assets in the trust. So sample applications, right? Who does a CLAT? Why do you do a CLAT? People that already give annually that do this, which is who's on the call here today. This is something you should strongly consider at least exploring because you're already doing this. And the difference is you're not optimizing the time value of money by getting a big deduction today. You're just doing it on an annual basis. Depending on what your goals are, could be a massive win for you. Income tax savings, again, you know, clients are motivated to redirect money from the IRS to charity. Estate tax savings, it's the same story, right? How do I get the IRS out? How do I leave more for my family? Maybe I leave more to a foundation. How do I eliminate the IRS from that equation? Capital campaign donations. So in that example where there was a balloon payment at the end, right, you could set it up specifically knowing that, hey, I really want to donate this big chunk of money at the end of the day because I've talked to my 501c3. I know that they're planning on doing this in 10 or 15 years. This would line up well with what their goals are. You could use it for naming rights and help with that. You could do, you know, it's generation giving. It's all of this in one wrapper. You can accomplish so many things with it. Next slide, John. So how do we implement this? Really, CPA needs to be on board because we're going to, once we do the 6-year projection, we're going to go back to them and say, hey, validate these tax savings numbers. We need an estate planning attorney and EPA to draft up the trust. I like to think I'd be involved to help them design it, but as long as you got somebody who knows what they're doing, you can get it designed up and make it super efficient. Cost-wise, there is a setup to set up the trust. Roughly speaking, let's on average call it $4,500. Annual tax filing, you do have to file a tax return. In our case, for the clients that we manage the assets, there are investment management fees that are in the equation. Now, Dana, I think you had some conversations here about the setup arrangements. You want to talk about that?
Sure. So there's a number of organizations that we work with, some of whom are on today's call, who in return for an irrevocable gift as part of a CLAT will cover the setup fees. So essentially it means that in year one, there is no money that changes hands. The organization doesn't get the donation and no money goes out of the trust, but those setup fees essentially get wiped out in exchange for the first year donation, so that starting in year 2 through however many years is agreed upon by the donor and the organization, there's an irrevocable gift that gets paid to that organization automatically from the trust. So it's a nice way to have those fees offset and a nice way for organizations to create an annual stream of donations that's a guaranteed multi-year gift.
From a time frame standpoint, the most important variable there is how quickly we get information turned around. If we get access, if we get to the adjusted gross income number pretty quick, and you know what you want to do, 2 weeks is reasonable. It's probably aggressive, but it can be done. We've done it in that time frame. 3 weeks, 2 to 4 weeks is probably the norm. Just setting the stage, right? I mean, there's some homework, and you got to be involved. If you want to do the analysis and you go on vacation, obviously that's going to slow down, but it's not hard. It's pretty straightforward.
Perfect. So now I think Kyle will stop and do a Q&A. A number of folks have privately messaged me their questions. So I will go down the list. A couple of them I think you covered, but may have gone fast. So I'm going to just have you repeat some of these answers again, if that's okay.
That'd be awesome.
Why would someone do a CLAT versus a charitable remainder trust?
The IRS moves the cheese around in terms of different tax planning strategies. And the cheese in this case is the 75-20 rate. And certain transactions are better in a high interest rate environment versus a low interest rate environment. This transaction works really well in a low interest rate environment. You could ultimately leave all the assets if you wanted to the charitable trust. It's so dependent on your individual situation as to which one you'd want to do. But the CLAT creates ordinary income tax back to you. And then the CLAT ends up giving all the remainder assets to the charity. So it doesn't fulfill that annual need because you're taking the money back. We're partial to the CLAT primarily because of the income tax and estate tax benefits and the interest rate as it is right now. The CLAT gets tossed in a high interest rate environment. The CLAT would be an ideal situation.
Can I comment on that as well?
Yeah.
Okay?
Yeah.
Yeah. Having been a nonprofit CEO for over 25 years and having run a foundation for 8 years, there's another fundamental difference between the charitable remainder and the lead trust. And I've experienced it personally in the organizations I've been with. On the charitable remainder trust, the remainder goes to the charity. Unfortunately, the reality is that the children and grandchildren whose lives and lifestyles and education and first homes and whatever else the family wants gets paid first. And there is often no remainder or very little remainder that actually goes to the charity. And because they usually include grandchildren, you're looking at 35 or 40 years. If a donor really wants to help the charity, they have to use a lead trust because the charity, and I've explained this to a number of people, we don't want your money. We just want to be able to use it for a period of time. And that's what the lead trust enables. And the charity on that constant stream can use some of that for operations, can use some of that to fund a reserve, can use some of that for any of a variety of their purposes. And at the end of the day, we haven't taken money from the donor. It goes back to their estate, to their heirs, to themselves. We're just using the interest income for a period of time. And once donors really understand that, it's a huge difference for the donors that actually want to benefit their favorite charity or charities, as opposed to the remainder trust. It's that simple, and that is the reality of how they work out. One actually supports charities, the other typically does not, at least not to the nature of the size of the gift when it was made.
The tax benefit for the donor. Yep. Well stated, Michael, and I appreciate that angle that you provided is awesome. That insight, right? That's your side of the table. I'm always on the client side of the table, so I was answering it more from a client side.
But from running a charity, much rather have a CLAT than a charitable remainder trust. I mean, they're not even comparable.
Thank you, Michael. I appreciate your additions.
Thanks, Michael.
So, Kyle, someone asked, can I change the amount I give to an organization after I set up the CLAT? And if I want to give the money away sooner, are there drawbacks and are there benefits?
So yes, but only in a situation where you want to give more. And so we are fans of flexibility and optionality. And in that example, the client set up to do $5,000 a year with the lump sum at the end. He's obligated to make that $1.2 million donation. They can accelerate it and give $10,000 a year. They could accelerate and do $15,000 a year as long as they give the $1.1 million. What they can't do is sign up to give $5,000 a year away and then only give $2,000 a year. So you can always increase the payment. You just can't decrease the payment. We have had clients that accelerate it when the time is right, and they've accelerated it by 5-7 years. They're like, hey, you know what? This organization needs the money. I'm going to give it to them, and they do it. And so there's a definite benefit to them getting the money to the charity that they want at the time they want. The downside from the estate transfer or the wealth generation standpoint is the longer, because of the because of the calculations and the time value of money, if the goal here is to kind of create this big nest egg for the family on the other side, by shrinking the time frame, you eliminate kind of the benefits of compounding interest and time value of money. But it's so specific to your family and what you're trying to do, and maybe you hit the jackpot over here and you really give the money away. So that's how I would answer that.
Thank you. And someone else asked if liquidity is a concern.
In what context? Well, does anybody have any additional on that? Is that you obviously want to be liquid yourself to make sure you have the money that you want to live on. And then from inside of the trust, you can invest in illiquid assets. That's not a problem.
Okay. And someone else asked, can I take money out of the CLAT or add more money to it after it's in place?
You cannot borrow money from the CLAT. You cannot take money out of the CLAT for yourself. Once the money's in there, it's in for the term. What was the second half of that, Dana?
Just can you take money out or add additional funds?
And you cannot add additional funds. So that happens. So part of that design process of figuring out, hey, what's your 6-year adjusted gross income and optimizing the whole thing is because you can't add additional money because the rate changes on a month, that 75/20 rate changes, you need to set up a CLAT each time you want to put money in there. So you need to figure it out ahead of time. You really need to be doing plus $300,000 into this trust. Probably get it right. We have clients that do multiple trusts throughout. We have clients that have 4 or 5 of them. They don't do them back to back like one month and the next month though.
Super, thank you. So someone else asked in the chat in terms of investment growth returns and limitations, is there a minimum amount of times that stock has to be held? And can she trade in the CLAT core basis short term, and where do the gains go?
So the time frame is just dependent on what your overall arching goals are. And the longer you have the CLAT, 15, 20 years, the better the economics are for the family, but you can shorten it up. If at the end of the day, charity is going to get all of the money, then it's really just a decision. Is it more impactful to shorten it up and have the charity have the money sooner rather than later? I hope that answers that question. And then, yes, you can trade in and out of that account. You don't want to create a bunch of short-term gains. You really want to be kind of buy and hold a little bit more inside of there, because if you sell out of a gain inside of that trust, you trigger a capital gain that flows back to you. Now there's some nuances, and you put somebody else in the trust and you can probably swap some assets and do some pretty unique stuff to mitigate that. But on the surface, hey, if you just trade a bunch of stuff and cause a big capital gain, it'll flow back to you. So I wouldn't necessarily recommend that unless you got a big loss.
And can the gains be swept into an outside account, or do they remain in the CLAT core?
They remain in the CLAT core.
Okay. And can you talk a little bit about the benefits of real estate and potential discounts on the assets?
So the real estate aspect, particularly leveraged real estate, multifamily, anything where you can get some more notional leverage and you get more notional value of real estate, because of current tax law, they can create this big tax deduction, and it makes it super tax efficient inside of the trust. So we like real estate. That's the short version on that. We like real estate inside of the CLAT, and we like that. And then to the discount piece, from an estate tax planning standpoint, if you could discount, you could definitely work to your advantage by getting discounted assets inside of there. If the person that asset knows what I'm talking about.
Perfect. And the last question that I'm seeing is, what is the minimum size where this transaction makes sense?
300, maybe a little bit lower, but 300. As that rate goes up, and I preface this with, as long as you're trying to leave some money to the family or it comes back to you. Economically speaking, as the rate goes up, the size probably goes up a little bit, but not a whole lot. If you're going to give it all to charity, it's not that big a deal.
Wonderful. Well, thank you. Those are all of the questions that I'm seeing. And so I want to thank Kyle so much for joining us, and thank you to everyone for attending today and for all of your thoughtful questions. If you have additional questions or questions that pertain to your particular portfolio, Kyle and I are both available at your convenience and happy to schedule some time to connect. We look forward to being your trusted resource and helping to serve mutual best interests of both donors and organizations. We're excited to help donors unlock additional potential while adding value by redirecting your tax dollars to the organizations in the community whose work you know makes a meaningful impact. We encourage you to ensure that your plans are in place now, especially with the upcoming legislative proposals, so that your estate doesn't automatically default to a significant tax bill that could otherwise have been avoided. We promise to make complicated financial transactions easy to understand and to help you leverage your estate to benefit your family and friends while also supporting our community. Thank you all again for joining us, and we look forward to being in touch.